presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact YouTube update for July 22nd, 2024. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. Again, don't forget to sign up for all the Compact YouTube updates, the podcast, the weekly newsletter, and all of the events. I will be doing a webinar next week, which is about an hour, and I will be answering all of your questions live on the air. So make sure that you sign up for that. All you have to do is go to compact.com/media. Sign up for the YouTube update. If you're watching this right now, just subscribe. So click on the subscribe button. Go to the podcast, which is about a half an hour to 45 minutes. Javed and I talk about what I talk about right now in a lot more detail. And then the quarterly webinar, which is much more detailed quarterly overview, what happened last quarter, what to expect next quarter. All of the information, all of it is free. All you have to do is go to compact.com/media. Looking at the markets, finally we're starting to get a little bit of a pullback. S&P down 1.95%, but the Russell still gained 1.69%, and the NASDAQ down 3.65% for the week. So what we saw is a rotation. The expectation is that interest rates are going to come down 2, maybe 3 times before the end of the year, and that is good for small caps. Finally, we see the small caps catching up over the next, hopefully over the next 6 months or so. They were about flat going into just about a couple of weeks ago. We had 0 here, and now we're up to 8.5%. While the S&P was up nearly 18, it's down to about 16% higher. So we're seeing this rotation. Is this for real, or is this just the one-week wonder? I'll talk about that in a little bit. Energy was the #1 sector last week. Worst sector, technology, which has been the leader for the year. Still technology up 27%. And energy is somewhere in the middle. It's only up 12.3%. S&P is still up 16.3 for the year. Looking at the oil market, it's coming down a little bit, correcting a little bit. I think, again, already $80 to $85 is the number that I'm looking at. Last week, we saw a little bit of a pressure on the market as interest rates popped back up. From 4.18, they went to 4.125, but still in that range. Nothing really dramatic going on there. This is why I think small caps are much more sensitive to interest rate reductions. If you look at the S&P 500, this is a share of companies that have floating rate. That means when rates go up, their debt cost goes up. When rates come down, their debt cost comes down. You can see the Russell 2000, 51 companies have floating rate compared to S&P of only 25. So what you're looking at is a percentage. 50% of the companies in the small caps are affected when interest rates go up. Their borrowing costs go up when interest rates come down. That is why last week we saw and the week before we saw small caps do much better, as the expectation came back in after we got the CPI numbers that the Fed could bring interest rates down starting in September. I wouldn't be surprised if they do it in the next month before that meeting. Is this existing? Not a lot of economic data coming out. Existing home sales up slightly better. Initial, we get the advanced GDP number, and again, consensus is 1.9%. So that would be a little bit of a pickup from the last time we got a GDP number, which was 1.4%. So that, I think, will be the big number that we get on Wednesday or Thursdays when we get that number, and that should give us some idea how the economy is doing. Looking at the technicals, we are fully priced here. We made the 5th wave top. 5650 was the number I'm looking at. Got a little bit above that. Now we're pulling back. This is red line is the 20-day moving average right here, and we're just sitting on that today, 5564. So we're sitting at it. If we get below the 20-day, we get to the 50-day, which is 5417. And looking at the weekly charts, it looks like we are completing the 3rd wave. This is wave 3. And then we start wave 4. 20-week is 5310. 50-week is 48.97 or so. That'll come up to about 5,000. As I said, if we do get a correction to the downside here, it could bring us down to somewhere around 5,100 to about 5,000 is what I'm looking at on the downside, which would be about somewhere around a 6-7% correction. NASDAQ also looks like it's completed a third, starting a fourth wave to the downside. Support is 17.4. And then if we get below that, then we have about 16.8 is the number I'm looking at right now. The weekly charts looks like 19.4 is the target on the upside. Last week was a reversal day down. No, what day? We didn't get above the previous week's high. Today we're pulling back. 20-week is 17,000 and then 15.4. We're about 18,000 today going into the close. A good day up as we saw rates back off a little bit today. So interest rates sitting at 4.26. 4.36 is the number that I'm looking at, which is the 200-day average of the yield on the 10-year note. If we get above that, then we've got 4.6 right about here, and then 4.75 right about here. On the downside is right about 4% is what I'm looking at right about here. So somewhere around there, as long as we're in this range, going back and forth, up and down, I really don't see a lot of interest rate fluctuations there. Crude oil got up to about 84, is backing off a little bit, sitting on the 50-day. We're more in the summer doldrums, not a lot of market moving news, a lot of people on vacation. So I think what we're seeing is the political, all the political turmoil that we have literally everywhere right now. Nobody's sure anything what's going on. We had a clear picture about 2 weeks ago. Now it's all jumbled up again. So we'll see how this all plays out. And I think the market is also taking a wait and see attitude. Looking at the small caps, this is the breakout. We had been in this sort of range right here, going from here to about here for about, this is since last year. For about a year, we've just gone back and forth, back and forth, back and forth, back and forth. Seems like we're finally broken out to the upside. Next target is this, which is 245. That is in October of 22. This is in 2021. About 2 years ago is when we hit this high. I would not be surprised if rates continue to come down. Small caps, as I said, could be a good area to look at because the biggest beneficiary of lower rates is the small caps, and they're the most undervalued right now. But you have to be careful because half the companies in the Russell 2000 are unprofitable. They're not making any money. So you have to find companies that are making money in the small cap index. That's the hard part, and that's why I would be careful. You have to do a lot of analysis and find the right companies that are making profits in the small caps. Gold did hit that 2,500 or 2,480 number that I've talked about for some time since April, and we went back and forth. Looks like we tried to break out. Now we've come back down, but this was my target, 2,480 to 2,500. If we can get above 2,500 decisively, break out above that, that would be bullish, but I think that only happens when interest rates come down. Again, I'm going to do a podcast in a lot more detail, so make sure you tune into that. I'll talk about that, and Javed and I both will, on what is going on in the markets and what to expect this week. If you need help with your portfolio, just email us at invest@compact.com. Simply go to invest@compact.com, and we will get back in touch with you. We will be in touch. We'll show you what we do, how we do it. Again, I will be back with you next week. Thank you for tuning in. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.